Hello, everyone. Welcome back to the Main Management Weekly Market Note. My name is James Maxwell, SVP of Research here at Main.
And I'm Alex Dippery, Research Analyst here at Main.
Great. We'll go ahead and get started for this week. Just to start out, our 4 ETFs and also our custom model partnership, per usual. Moving to the performance for the week ended as well as year to date. You've kind of continued to see on the year to date this move towards the pro-cyclical areas of the market. So on the industry-wide kind of global markets, you're seeing emerging markets, small cap and commodities all lead the way. On the domestic sectors, that's materials and energy leading the way there, both very sensitive to those commodity prices. Over the past week, kind of continued that trend. Energy materials led the way on the week, and then commodities led it for the broader indexes. Recession dashboard remains more green than blue. No changes here from last week. Starting out with the core PCE figure, that was one of the big things that we received last week. And as you may or may not know, this is the Fed's preferred inflation measure. It came in at 0.16 month over month for November. It was the smallest increase since March of 2025 and in line with forecasts. Overall, I'd say it's just continuing to see that moderation in inflation come down, even with the tailwind or headwinds or tailwinds, depending on how you look at it, of tariffs, of continued kind of stickiness in certain areas of the economy. We're now at 2.79% year over year, which has kind of been that 2.5 to 3% range that we've seen for now a number of years. But it's at a level where the Fed is comfortable enough to where they can focus on the other areas of the economy. It's not, the same level it was in 2022, for example, where they had to hike aggressively. With that, we also saw consumer spending that's part of that report. That was up 0.51% month over month. That's its 10th consecutive positive reading. And the year over year figure raised to 5.4%. Continued strength there, kind of in that trading range, so to speak, over the past couple of years.
Yeah, and I'll also mention that another metric of inflation that some people look at, the trueflation metric, is now under 2%. So when we talk about the Fed being able to focus on the labor market side of the equation, if the true number ends up being a little bit closer to that, that's even more amplified there.
Mm-hmm. Moving to the other part of the report, income, that was up 0.30% month over month. That was up from just 0.12 in October. The year over year continues to kind of trend downwards there. We've seen that in other other readings on incomes as well. You had a really strong income growth 2022, 2023, and that's just kind of moderated more and more. That's tied obviously to the labor market moderation as well. People are not able to request higher wages or switch jobs or do things that make their wages grow as much as they could maybe 2 or 3 years ago. On the right hand side, you see this personal savings, which is basically a residual of how much total income and then how much spending there is. That's continued to fall as you've had incomes slightly decelerate at a faster rate than spending. But they're using their savings to continue spending, resulting in a cash pile that's continued to grow overall, just at a slower rate than before. So there's still plenty of cash kind of in the coffers, so to speak, especially in the baby boomer generation. There's now 85 trillion worth of net worth that could really drive the savings rate even to negative because they're spending all this excess cash. They're not earning anything because they're retired or they're in a stage of life where they're not earning as much, but their spending exceeds that level of income. So we're keeping an eye on that. It's not a huge kind of thing to worry about. It's just something that explains the kind of data discrepancies. On GDP, we also received the final reading for Q3. Obviously, this is now 4 months in the rear since Q3 ended, so not a leading indicator by any means, but it's good to see the strength there. It was revised slightly higher to 4.38% quarter over quarter annualized. That's ahead of the 4.34% that was previously estimated. So that's actually the strongest quarter now since Q3 of 2023. A lot of that was driven by consumer spending on the underlying. You can also see exports were revised up considerably in this past reading, and imports were also revised up from the prior reading. Consumer spending, although it was strong, was revised downward to 3.45% quarter over quarter. That's still a strong reading, above 3%, a pretty strong reading for consumer spending, but on the margins, it was just revised.
Yeah, and it's important to remember that consumer spending is around 70% of the GDP reading. So you look at, Q1, Q2, where it was a little bit weaker. It's pretty encouraging to see it start to tick up more despite the marginal downward revision.
Mm-hmm.
Um, and I think this, especially interesting amidst continued low sentiment readings, which we'll get to in a bit. But despite very depressed sentiment, the consumer spending element of GDP is still very strong.
Yeah, I mean, running at 4.4 on the GDP figure is certainly strong. Of course, you had a negative reading in the first quarter of the year, but kind of at a run rate 4.4 is very strong. So it's good to see overall, and it's being kind of driven broadly, not just kind of one thing driving it. It's not. I know there's a lot of commentary on like the AI data centers driving part of GDP. Yes, that's a part of it. Yes, that is business investment. But consumer spending, which doesn't include any sort of AI data centers or anything, is obviously running pretty strongly as well. This is looking at GDP per capita. It also is at an all-time high at now above 70,000, up 3.74% quarter over quarter. Again, the biggest increase in a few years. In this case, since 2021. Corporate profits also posted an increase. They're also at an all-time high at 3.41 trillion. And those are up over 10% year over year, which is the largest gain since Q4 of 2023. So strong growth on the income side, strong growth on the consumer side, strong growth on the corporate profit side. Overall, like I mentioned, broad-based improvement here. On consumer sentiment, this is the University of Michigan Consumer Sentiment Survey. It was revised higher this month from the preliminary reading of 54. It's now at 56.4. But overall, it's still pretty depressed. You can see that on the left-hand side there, that even prior to COVID, it's below that reading. And even prior to or even relative to 2022, it's kind of right at that range when inflation was at 9-10%. So it's very kind of depressed here. There's all sorts of opinions on why it's so depressed. Part of that might be the broader environment, the broader kind of political environment. People are still feeling the pain of inflation, even though it's in the rear. The kind of looking at the sticker price shock is still happening. I don't know if there's other things that you are looking at for this, Alex, but what's on your mind there?
Yeah, I would say one thing interesting to look at within sentiment, and this is something we've done before, is break it out by income level. Again, going back to that, consumer spending figure a few slides back, the bulk of that is made up by, or a majority is made up by high income earners. And so when you're actually breaking out sentiment by income level, if you see it sort of ticking up for that highest income group, that's overall a positive for spending. Yeah, but still very depressed overall. Be interesting to see where we go from here.
And also, I think that ties into like, yes, it's positive for the overall spending figure. The highest 10% of earners obviously make up a huge share of that spending because just the way that the math works. But for something like consumer sentiment, which it doesn't, it's not weighted by income. It's kind of an overall average across all demographics. That's where you'd see lower sentiment, but higher spending, which,
right.
Might be a good thing or a fine thing for the economic data, but for kind of broader societal discourse and function might not be as good of a thing. On to flash PMIs here. We got those globally. Overall, the manufacturing were more up than down, kind of continuing to see over the past few years, most on a broad base, manufacturing taking up, or at least slightly moving up. Services were more mixed kind of across the board. U.S. was unchanged, continuing kind of at its 8-month low of 52.5. So still an expansion, but not as high as it was over the past couple of years, or the past year at least. But overall, pretty mixed on the services. Finally, on the Japanese bond yields, this has been a topic of of discussion. I know that you were talking about this. So maybe you just want to take on what you're seeing here and kind of what the factors are driving it.
Yeah, I think this is a story that's been going on for a while. Obviously, recently it's been getting a lot more attention. Something pretty significant here is just this week, the yield on the 10-year for Japanese bond yields rose above the dividend yield on the
Mm.
topics, the Tokyo Stock Index, which is the first time that's happened since the Great Financial Crisis. I think what you're seeing is markets really starting to become concerned with how elevated debt to GDP ratios are. By the way, Japan is the most extreme example of this, but this is by no means sort of exclusive to Japan.
Mhm.
You're seeing it in most major economies and their sovereign yields. The exception there, of course, being Switzerland, which has a very sustainable debt to GDP ratio, where there's not as much of a concern there. More broadly, you know, this sort of is starting to price in the tail risk of, the erosion of value of fiat currency. It's tied into the story with what you're seeing with precious metals,
Mhm.
with what you're seeing with some of the sector movements this year. So this is definitely a concerning trend. So far, it's you know the extreme case is reserved to Japan, but you
Mhm.
are starting to see yields, especially long end yields, creep up for a lot of countries.
Mhm. I mean, it's as they say, like the bond vigilantes. Long-term yields are so critical to kind of a entire economy's success and functioning is so much is driven off of that. Things like all sorts of loans, mortgage rates, auto loans, kind of anything
Yeah.
that's longer term is driven by, or at least based off of those government yields. So very important to keep an eye on, even though domestically it's kind of less of an issue right now. Certainly, a lot of developed countries are experiencing this. And that's all for this week. Just in summary, we had the core PCE inflation reading that's kind of continued to remain in its trading range, so to speak, between 2.5 and 3%, which the Fed seems to be fine with overall. We also got the final reading for Q3 GDP. That was revised higher. Obviously, it's 4 months in the rear, but certainly a strong reading and something to be positive on. We also got Michigan consumer sentiment revised up, but overall still remains relatively depressed relative to basically any time in history. Flash PMIs were more positive than negative. All of the manufacturing figures improving, even though the U.S. fell a bit short. And finally, we just talked about the Japanese bond yields soaring higher as the Bank of Japan's kind of trying to figure out their policy rate, maybe using too much physical stimulus, seemingly at least to the response of the bond vigilantes. But we'll keep an eye on that and kind of global yields in general. Data this week: get durable goods orders today, Monday. On Thursday, we're going to get Q3 productivity, trade balance, and factory orders. Productivity has been something we've been keeping an eye on. It had a good reading in the last release, so it's going to be interesting to see how that kind of is revised. And then finally, we'll be getting PPI on Friday. That'll do it for this week. Thanks for joining us, and we'll see you next time.